Hello, and welcome to Bitesize Legal, where we tackle legal issues one bite at a time. My name is Drew Jenkins, and I'm an attorney licensed in Georgia and Alabama. And today, we're going to take a bite out of depreciation for real property. Now, first, if you live in your home and treat it solely as your personal residence, and or you have a vacation home that is also used solely as a personal residence, then this isn't useful to you. Second, when it comes to actually implementing a depreciation strategy, that's where the accountants come in, right? As the attorney, I can give you sort of the legal contours, but to put it into practice, you need to work closely with your CPA to determine the type of depreciation schedule that works best for you. But first, we're going to talk about cars. You know that when you purchase a vehicle, the moment you drive it off the lot, it's worth less than what you paid for it. And most things we buy are the same way, that over time, the value of that asset becomes less and less and less. And then ultimately, when you do sell it 10 to 15 years from now, you're going to get basically a salvage value, or you're going to get a lot less for it than what you paid for it. Now, generally, when you purchase an item for a business purpose, you're able to expense it, right? You go to the store, you buy some supplies, you write it off in the year that you acquired that asset, and you don't worry about it. And when you write it off for tax purposes, that asset will have a value of zero. So let's say that you buy a lot of printer ink, you pay $200, you bought a bunch of it, and you decide that you're going to sell it a year and a half from now. Well, whatever you receive from the sale of that ink, that's going to be taxable income to the business because you wrote it off entirely in the year that you bought it. And so now we're going to recapture that as 100% gain. Now, when you're starting out with a business, that may not be very useful to try and take an enormous loss, or in the case of real property, you may not be allowed to write it off. So what happens when you can't write it off? You capitalize it instead. So you talk to your accountant, you add it as an asset. So if I spent $500,000 purchasing a nice home for a business purpose, I haven't actually lost $500,000. I've actually just turned the cash into an asset, i.e. the house. Or if you buy a vehicle, it's the same thing. Now, like with the car, we are going to say that part of the value of that house, or the house itself, will decrease in value every year. Now, we hope that is not the case, but for tax reasons, we're going to treat it exactly as we treat a car. We're going to say that every year the house itself is worth less. Now, I hope you caught that. I didn't say the purchase price is worth less. I didn't say the land is worth less. I said the house. And this is where the first trick that you need to know about depreciation exists. When you go to depreciate real property, you do not depreciate it on the basis of your purchase price. You depreciate it on the basis of the value of the improvements. An improvement simply means anything that's not the land itself, right? It can be a barn, it can be a commercial high-rise. And the second question is, well, how do you calculate this taxable basis then, right, to begin your depreciation schedule? One way to do it is you can put it in the contract. You can specify I'm paying, $100,000 for the land, and I'm paying $400,000 for the house. Then I get to depreciate the $400,000 for the house. A more common way to do it, and probably I think the only way that's really done in the residential world, is you go to your tax records. When the tax assessor is determining the value, they determine the land separately from the value of the improvements. If you've ever looked at the tax assessor, you'll notice that everything is itemized. What you'll do then is you'll take the total assessed value and you will subtract out the value of the land, and then you will divide it back into the total. I know, it's fun. We're going to run a percentage here. It's the ratio. It's the ratio of the improvements over the ratio of the land. And that will tell you the number that you will depreciate. Next question is, well, how do I actually depreciate? That's a good question. We are going to pretend, the IRS is going to pretend that that house will become essentially valueless if it's residential property in 27 and a half years. Which means you will take the value of the improvements and you will write them off over the span of 27 and a half years. If you are dealing with commercial property, it's 39 years. So that nice commercial building you bought, you're going to determine what part of your purchase price was allocated to the building versus the land. And then you will take the building's portion and you will Slowly take losses every year until it reaches essentially a zero value at the end of year 39. So for residential property, 27 and a half years is your taxable life. And for commercial property, 39 years is your taxable life. Now, how much do you reduce every year? How much of a little bit of a loss do you take? That is going to be determined in consultation with your CPA. But the simplest is a straight line, and it's easy enough. You've determined what your depreciable basis in the property is. You divide it by 39 years if it's commercial, and every year you will write off that amount of money as a taxable loss. There are other methods that are very common and they exist. The other most common ones are the double declining method and the MACRS, which is a modified accelerated schedule. Again, the best way to figure out which is best for you is actually to talk to a CPA rather than an attorney. So the big picture to take away is depreciation only exists for real property that is being used for some sort of business or investment purpose. It does not apply to land, but only to the value of the land. If you didn't specify in your purchase and sale contract how it is allocated, you'll go to the tax rolls to help you determine the allocation. Then, if it's residential, you will take losses every year for 27 and a half years. If it is commercial, you will take losses for the next 39 years. Exactly how fast you write it off is going to be determined in consultation with your accountant. And that is a bite out of depreciation. So I hope you found it useful and informative. Leave comments below. If you're watching on WeChat, you can respond in thread. You always feel free to shoot me an email, and otherwise I will see you next week.